Around 3.7 billion people on this planet have never invested a single dollar. And what's even crazier is that about 70% of them say they would invest if they knew how. Why this matters. People can work their entire life, 40 plus years, working, paying bills, doing everything they were told to do. And yet at the end, they never actually achieved financial freedom. And look, we only get one life to live. And people working their tails off their entire lives and actually not figuring out how money works is probably not what most of us had in mind. By the end of this video, I'm not only going to walk you through why investing matters, I'm literally going to show you the first step you need to take to start investing today. Hands down, this might be the most practical investment advice you hear, and it's only gonna cost you about 15 minutes of your time. And what you could gain from understanding this could completely change how you think about money and moving forward. So the very first thing you need to know before you invest a single dollar is you actually need some financial breathing room. You need to have an account that's there for you when the unexpected happens in life. Things happen all the time. Cars break down, water heaters break, roof needs fixing, kids need something that's expensive, or a health issue happens. Unfortunately, there's not a little notice that says, hey, guess what? It's happening. It just happens. And if you don't have the financial resources ready for something like that, you end up in a pickle trying to figure out where you're going to come up with those funds. So the first thing you need is an emergency fund, which is basically a fund that has about 3 to 6 months of your monthly living expenses. So if you live on $5,000 a month, that's roughly around $15,000 to $30,000 that you need in an account that's very liquid and in cash so that you can easily access it when something like this happens unexpectedly to you, because it always will. Life will continue to do that. Another reason this is very important is probably one of the things that most of us don't want to talk about, and it's job loss. And it can happen, and it's very common. But if you think about having a resources where your funds are going to be safe and secure, and you're going to be able to make your monthly needs for the next 3 to 6 months, that's normally enough time to get back on your feet, find another job, and yet still maintain the same lifestyle you had without having to go down to the store and buy some ramen to live off of instead of something that you actually would enjoy.
No, God, please, no!
One thing to keep in mind when it comes to an emergency fund that's extremely important and most people overlook is that if life happens and you actually have to dive into it to spend some money from it for the water heater, for a job loss, to maintain your lifestyle, it's completely all right. But the next thing you have to do once you get back on your feet and you have that extra income from the new job or whatever it might be, you have to replenish the emergency fund to maintain that 3 to 6 months. Because if you don't, now you don't have that emergency fund and you aren't on the financial stable ground that you once were when you had it put in place. The next thing you want to tackle after you have an emergency fund is high interest debt. Now, not everyone has it, but a lot of people do. And if you're one of those people, you do want to tackle the high interest credit card debt that you have accumulated first before you ever invest a single dollar. And you might say, why? And the reason for it is that with some of the interest rates on credit cards, they can be as high as 12 to 18%. And people will come to us and say, hey, can you invest money? And I will say, absolutely, but I can't guarantee any returns ever, nor can anyone else guarantee returns. But one thing I can guarantee is you pay off your credit card debt, you aren't going to have to pay 12 to 18%, which is going to save you a lot of money and start making that financial freedom much more clear. When those two things come together, something really important happens. Your money is no longer reacting to your life. So then the question becomes, Brian, how do I actually start investing this extra cash I have? So when you start investing, there's a misconception that you think you have to have a ton of cash lying around before you can do it. And it's completely false. You actually can start with this very small amount, and you actually should, right? Because you just got your emergency fund, you paid off your high interest debt, and now it's time to invest. You probably don't have thousands of dollars lying around, and you don't need it. You only need a small amount, because that's the fun trick with investing, is small amounts can turn into extremely large numbers if you're consistent with it, which is what we're going to talk about. Small amounts can turn into very large sums. And one of the best analogies I like to use is the golf analogy. Let's say we go out and we're going to play a round of 18 holes. The fact is I could say, hey, whoever wins this golf round, we'll pay $1 million to. That sounds pretty great. But what if I said on each golf round, whoever wins gets a penny, and at the next hole, we're going to double it. So the next hole, you're going to get 2 cents. Next hole will be 4. The next hole will be 8. You're probably going to say, hey, maybe I should pick the $1 million because, well, we're only at 8 cents, kind of far into the range. The fact is you are right up until hole about 16, when that actually is going to overcome that $1 million that we talked about. And then you're going to end up with way more money actually by taking the fact of the doubling effect, which is really what compounding is you put money in, it grows, probably isn't going to double, that's a hard thing to do, but even at 10%, grows at 10%, and then that money plus the 10% is going to grow another 10% the following year. And then that money plus the money you just made is now growing again at 10%. And so you keep having more and more money actually making that 10% that the market's producing. Again, this is hypothetical, but it does work that it keeps getting to be a much bigger and bigger number as the years go on, which is why starting now and having just a small amount can make such a big difference in the future. So let's actually talk about what people are investing in 2026. What they're doing and how I would recommend they do it is, first and foremost, after you got your emergency fund, after you pay off your high interest debt, is now you're going to start investing. One of the first places I tell people to look is in their retirement plan with their company, or a 401k, simple IRA, or whatever it might be. And the reason for it is with most companies, they will actually give a match, meaning that if you put some money in, they will also put additional money in. And I always tell people, kind of joking with them, is that everyone wants to make more money. But the fact is that if you aren't contributing to your 401k or your retirement plan with your company where they offer a match, you're basically walking away from additional income because the company's willing to give it to you. You just have to put your own money away into your retirement. Now, once you've reached that match, right? And sometimes it's only 3 or 4% that they'll match up to. And I'm not saying going over that. The second part that I would look at is going into probably a Roth IRA. Roth IRAs are fantastic because they can actually grow tax-free, meaning that's money after taxes that goes in and grows tax-free with the interest that it makes or with the capital appreciation that it makes on the stocks that you have it invested in. So it can be a very powerful tool as you're planning for retirement and that financial freedom. So that's my second step that I tell people to do, is to look into that Roth. Make sure you're going into that. That is going to be limited to a certain amount. The max contribution for a Roth in 2026 is $7,500. If you're over 50, you do get the catch up as well. So it can be a small amount. And then once you have extra cash beyond the 401k, beyond the Roth, the next step is going to be going into a taxable account, which sometimes is very overlooked by investors. Obviously, they think they should maximize those two accounts first. But what I tell people after the Roth, I advise people to invest in a brokerage account or a traditional just taxable account, basically just a normal account, nothing too special. I think this piece is actually overlooked by quite a few people because they overemphasize making sure they put money into their employer plan or into their Roth, which are fantastic. But the big piece is that if you have goals of wanting to retire sooner or earlier, this taxable account is really what's going to make the biggest difference for you, because that money is not tied up. It's not considered what's called qualified money. And so there are no rules or regulations around when you can access it or when you can take it. You can take it whenever you want. So it almost adds kind of as that second layer to your emergency fund, but it can be for kind of other things in the sense of an early retirement, paying for medical expenses before Medicare kicks in. So it can be a very, very useful tool for people wanting to retire a little bit earlier. Another thing investors think about is taxes. One, no one wants to pay more. I've never met someone who says, hey, let me pay more in taxes. So one of the big things is how do you have your investments grow, thinking about taxes and being tax efficient? And that's where a lot of these accounts kind of work together, and why each individual situation is going to be slightly nuanced based on what your situation is. Because obviously, if you have money going into a 401k, it could be deferred, meaning you haven't paid taxes on it, and that growth will then grow without having to pay taxes on it until you take it out. You could then have your Roth account, which you pay on taxes in the year you make it, but then that money grows actually tax-free, meaning you're not going to pay taxes on it again. And then you have your brokerage account, which we talked about, or the taxable account, where obviously the only time you're really going to pay taxes is on the growth of that account, but it's only when you take the money out or sell a stock or a position or ETF or mutual fund. It's when you sell that and move to something else that taxes will be due on the growth. So you might be wondering, the hell is an ETF? I've said it kind of quickly, thrown it out there, but let's kind of dive into that. But before I do that, I kind of want to explain two things, or use the analogy I like to share with clients. We've talked about the 401k, we've talked about a Roth, we've talked about a brokerage account. The way I like to say it is those are garages. Those are where you can store your investments, right? They aren't an investment in itself. The investments, or the cars that you can park in any of those garages, can be a stock, can be an ETF, can be a mutual fund, can be a bond, can be many other other things as well. But the fact is a stock is basically just an equity ownership, right? So you have actual ownership in that company. So if you were to buy a company like Apple, you have ownership in that company. And when it does well and it has profits, you do well as well. No recommendation to buy Apple, it's just how that works. A bond is basically an obligation. Basically think of it like a mortgage, but you're the bank who gave the loan. So you now have the obligation to get paid back plus interest. So it's a much safer position, but certainly doesn't have the growth of the stock with the equity side. Those are the individual pieces of it. The second layer of that is you go to an ETF, stands for an exchange traded fund, is what that means. And all it is it's basically a group of investments tied together. Think of it like the S&P 500 that's touted on the news constantly. That all it is basically an index that's made up of 500 of the largest US companies, and you own a piece of all of them based on their market cap, right? So you'll have a little bit more of one company, a little less of it, but as long as they're in the top 500, you will own a piece of it, which is more diversified than owning one single stock. You can also have a mutual fund, which pretty much is the exact same as an ETF. Most people are more familiar with a mutual fund, they've been around longer, but the fact is it works almost identical in the sense of that it's a group of stocks within that, or a group of bonds within it that you own. So it's kind of a diversified piece within one position. So one position in an ETF or a mutual fund could hold hundreds, almost sometimes thousands of different positions within it. And so many different ways that you can invest your money, but those are the cars that go into all the garages like we talked about with the Roth, with the qualified account or your company account or the brokerage account. So we talk about tying all of this together. What we're really talking about is financial planning. And what financial planning is really just looking at everything as a whole, putting it into one picture. So taking your stocks, taking your investments, taking your taxes, taking your estate plan, taking your insurance, taking all things that matter. Basically, I like to say, pretty much think of it anything that has a dollar sign in front of it, putting it together and actually making it make sense, putting it in place so that it actually is working for you and designed so that you actually can hit the goals that you are trying to achieve in your future. Another big piece that no one normally talks about when it comes to investing is behavior. And the stock market can invoke a lot of different emotions. It can be up, it can be down. And the old adage is buy low, sell high. And that's extremely easy to say, and it is much harder to do. There are so many people when the market is going up that will constantly say, hey, I don't want to miss out. And so they'll want to rush in, right? And it's probably not the best time. On the flip side is when the market goes down and there's fear and everyone thinks, oh, it's gonna go to zero, and they rush out and they end up selling when they didn't really want to. So when people decide that the market's going down and they are scared and they decide to rush out, they end up doing it in the wrong reasons, right? Because they're fearful of it. And that's really where a financial plan comes into play, because what it does is it actually puts things into perspective for you. Because what happens is that you end up having more of a plan as far as where the diversification is coming from, why you need to be invested in a certain way, and it sets the parameters of why you might need to make a change. Because one of the big things that I always like to tell people is the market's going to go up, it's going to go down. We have no way to actually perfectly predict it. No one actually has done that. Some people have gotten lucky a few times, but they haven't done it perfectly all the time. So to that end, one of the things is that you don't want to be changing your plan or your investment philosophy while the market is moving up and down. But what you do want to do is adjust your plan based on when your life changes, right? You go through different cycles of life. You end up having kids, you get married, the kids go off to college, the kids are graduated and living on their own, you're retired. All these different phases require different parts. It might change kind of one of those three things I mentioned before as far as your risk tolerance, your time horizon, and your goals. All of those have different meanings at different times in your life. But having a plan to kind of help you along the way to kind of have that reassurance for when things get really haywire in the market keeps people from doing things they shouldn't do and jeopardizing their future. The last piece that people really don't understand is inflation. It's the silent killer to almost every single portfolio out there. And really what it is just the fact of that things get more expensive year in and year out. And we don't have to go back too far to really see gigantic examples of that. We go back to when we saw eggs hit $9 or even $10 at the grocery store. It's not hard anytime right now, especially in 2026, to go to the store, to go to any store, whether it's a supermarket, clothing store, I don't care. Things cost more. And that's just a fact of inflation. So let me explain why inflation exists. And it really comes down to the fact of how the government's formed, how it actually is done. So we're not going to get into too many details about it, but the fact is that the government does end up printing more money. And as we have more money hit the system, it actually devalues the dollars we have. If you want to think about it, it actually devalues the debt we have, which is why it's helpful to them. And we also went off the gold standard in 1971, but the big piece that what is happening, that the dollars we have in our pocket are basically being made worth less each and every single year, right? And so what that means is it's kind of the silent killer in the sense of that, yes, I could have my, $1 million that I saved and I put it in my backyard and I buried it. And now when I dig it up, the $1 million is still going to be there. Right? But the fact is that if I dig it up in 20 years from now, that $1 million will not be the same in the sense of that it won't go nearly as far. It won't buy as many things because more things have increased because we've devalued everything. And so that's kind of where inflation comes in and why it's a silent killer and why having your investments and your money grow above and beyond what the inflation rate is so important. So when you combine some of the key foundations we talked about earlier, as far as having your emergency fund, as far as not having any high interest debt, as far as putting money away on a consistent basis in one of the plans we talked about, whether it's a company plan, a Roth, or a brokerage plan, when you start putting it into a plan and considering the taxes, the inflation aspect of it, your estate aspect of it, your insurance aspect of it, something really magical happens in regards to the money. It actually changes from feeling like a burden to actually being a tool that is actually working for you instead of against you. And that's where real financial freedom starts to happen. When you look back at everything we've talked about today, investing starts becoming a lot more clear and way more meaningful. It starts with building a real foundation and then investing consistently and then tying everything together in a real financial plan. When all those pieces come together, people stop guessing with money and start having real confidence about moving forward. The biggest thing I want you to remember is that financial investing isn't just for financial experts or wealthy people. Most investors are normal people who started learning and taking small steps forward. Over time, those small steps can turn into something really meaningful. If you're thinking about getting started, there's a link waiting for you in the description below. Click the link to start the conversation for what investing could mean for you. I'll see you there.